Jeff Bezos has sold $13 billion in Amazon stock. Mark Zuckerberg has sold billions in Meta shares. Jamie Dimon, CEO of JP Morgan Chase, sold stock for the first time in his 18-year tenure. Larry Ellison sold $3 billion in Oracle. The Walton family has sold billions in Walmart. NVIDIA insiders have dumped stock at record levels while the stock hit all-time highs. This isn't diversification. This isn't tax planning. This isn't coincidence. This is an exodus, the largest coordinated insider selling event since 2007. And we know what happened in 2008. They're not selling because they need the money. Bezos is worth over $200 billion. Zuckerberg is worth $180 billion. These men could never work another day and live like kings for 10 lifetimes. They're selling because they see something you don't, something in the data, something in the economy, something that tells them current valuations are unsustainable and the risk of holding is greater than the regret of selling early. Let me show you exactly who's selling, how much they're selling, why the timing is identical to 2007, and what happens next. Because this pattern has played out before. The insiders always know first. They always sell before the crash, and they're selling right now. Let me start with a scale because most people don't understand how extreme this is. Insider selling, the amount of stock sold by executives and major shareholders of companies, hit $464 billion in 2024. That's the second highest year on record. The highest was 2007 at $650 billion. We know what happened next. 2008, the financial crisis. The S&P fell 57%. But here's what makes 2024 and 2025 even more concerning. The ratio of insider selling to insider buying is at the most extreme level in history. The sell-to-buy ratio measures how much stock insiders are selling compared to how much they're buying. A healthy market sees a ratio around 3 to 1. Insiders sell $3 for every dollar they buy. That's normal. People diversify, pay taxes, fund personal expenses. But in 2024, the ratio hit 9 to 1. Insiders are selling $9 for every dollar they buy. In some months, it's spiked to 12 to 1. This is not normal diversification. This is panic selling disguised as routine transactions. And it's not just the amount, it's who is selling and when. Let me show you the specific names, because these aren't random executives at failing companies. These are the most successful investors and operators of our generation, and they're all selling at the exact same time. Start with Jeff Bezos. In February 2024, Bezos filed plans to sell 50 million Amazon shares. That's approximately $8.5 billion at the time. He executed those sales throughout 2024. Then, in July, he filed to sell another 25 million shares, another $4 billion. Total sales in 2024, over $13 billion. Bezos founded Amazon. He's been CEO. He built it from a garage to a $3 trillion company. He knows Amazon better than anyone on earth. And he's selling, not a little, $13 billion worth. The excuse given to the media was that Bezos moved from Washington state to Florida. Florida has no state income tax. So selling stock after the move saves on taxes. That's the official story. But Bezos has been a billionaire for 25 years. He could have moved to Florida any time in the last 2 decades and saved on taxes. Why now? Why sell $13 billion in 2024 specifically? Because the market is at all-time highs. Amazon is at all-time highs. And Bezos sees the same data everyone else sees. Extreme valuations, coming recession, inevitable crash, get out while prices are peak. Mark Zuckerberg, CEO of Meta. In 2024, Zuckerberg sold approximately 400 million shares of Meta stock. That's roughly $170 billion. No, wait, let me correct that. 170 million shares worth roughly $40 to $50 billion depending on when sold, even accounting for Meta's stock price fluctuations. These are his largest sales ever as a percentage of holdings. Meta stock hit all-time highs above $500 per share in 2024. Zuckerberg created Meta. He controls it through super voting shares. He could hold forever and never need to sell for money, but he's selling billions. The official reason? Funding the Chan Zuckerberg Initiative, his philanthropy. That's possible. But the timing is curious. He could fund philanthropy in a year. He chose to sell massive amounts in 2024 when the stock hit records. That's not coincidence. That's market timing. Jamie Dimon. This one is the most significant signal of all. Dimon has been CEO of JP Morgan Chase since 2005. 19 years. In all that time, he never sold a single share of JP Morgan stock. Not one. He's preached to investors about long-term holding, about believing in the bank he runs. He's compensated in stock specifically to align his interests with shareholders. And in 2024, for the first time ever, Dimon sold. He sold 1 million shares, approximately $150 million. The company disclosed this as part of a pre-planned trading program for estate planning and diversification. Estate planning. Dimon is 68 years old. He could have done estate planning any time in the last 15 years. But he chose 2024, when the market is at all-time highs, when bank stocks are elevated, when, as the CEO of the largest bank in America, he has access to data about the real economy that nobody else sees. He sees loan defaults rising. He sees commercial real estate collapsing. He sees consumer credit maxing out. And for the first time in 19 years, he's selling. This isn't estate planning. This is the ultimate insider signal. Larry Ellison, co-founder and chairman of Oracle. Ellison sold approximately $3 billion in Oracle stock during 2024. Oracle stock hit all-time highs on AI hype. Every tech company is racing to build AI infrastructure. Oracle provides databases and cloud services for that infrastructure. The stock more than doubled from lows. And Ellison, who's been involved with Oracle since he founded it in 1977, sold $3 billion. He's worth over $150 billion. He doesn't need the money. He's selling at the peak. The Walton family, heirs to the Walmart fortune. In 2024, various Walton family members sold over $2 billion in Walmart stock. Walmart, the company their grandfather Sam Walton built, has been the family's core holding for 60 years. They've rarely sold significant amounts, but in 2024, multiple family members executed large sales. Walmart stock is at all-time highs. The family is cashing out. NVIDIA insiders. This is perhaps the most extreme example. NVIDIA's stock went from $120 in January 2023 to over $450 by late 2024, a nearly four-fold increase in 2 years. AI boom. NVIDIA makes the chips that power AI. Every major tech company is buying NVIDIA GPUs. The demand is insane. Revenues and profits are exploding. But what are NVIDIA insiders doing? Selling. Executives at NVIDIA sold over $700 million in stock in 2024. The CEO, Jensen Huang, sold over $700 million personally. The company is growing faster than ever. The stock is soaring, and the insiders are dumping. Why? Because they know the AI bubble will pop. They know current valuations assume decades of perfect growth, and they know that's impossible. So they're selling while retail investors and institutions are buying at all-time highs. The pattern is undeniable. The most successful investors and operators of our generation, people who built trillion-dollar companies, people who've been holding stock for decades, they're all selling. At the same time, in 2024 and continuing into 2025, and the scale is rivaling 2007 levels. Now let me show you what happened in 2007 because the parallel is exact. In 2007, insider selling hit $650 billion, the highest year on record at that time. The sell-to-buy ratio spiked to similar extremes as today, 8-to-1, 9-to-1. And the specific insiders selling were the most successful people in finance and business. Angelo Mazzillo, CEO of Countrywide Financial, the largest mortgage lender in America, sold over $140 million in stock in 2006 and 2007. Countrywide stock was at all-time highs. The housing market was booming. Mazzillo was celebrated as a genius, but he was selling. Why? Because he knew the mortgages his company was originating were garbage. Subprime loans to borrowers who couldn't afford them. Loans that would default the moment housing prices stopped rising. He knew the crash was coming, so he sold. By 2008, Countrywide was bankrupt. Sold to Bank of America for pennies. Mazzillo's stock sales in 2007 were at $140 per share. By 2008, the stock was worth $4. He got out at the peak. Richard Fuld, CEO of Lehman Brothers, sold over $250 million in Lehman stock from 2005 to 2007. Lehman was one of the largest investment banks in the world. Fuld had been there for decades, but he sold massive amounts at the peak. Lehman Brothers filed for bankruptcy in September 2008. The stock went to zero. Fuld's sales at $40 to $80 per share saved him $250 million that would have evaporated. Stan O'Neill, CEO of Merrill Lynch, sold over $70 million in stock in 2006 and 2007. Merrill Lynch collapsed in 2008, sold to Bank of America to avoid bankruptcy. O'Neill got out at the top. The pattern in 2007 was clear. The CEOs of the banks and mortgage companies that would collapse in 2008 were systematically selling stock at the peak. They knew the housing bubble was unsustainable. They knew their companies were loaded with toxic assets. They knew the crash was coming. And they sold. Then, 12 months later, the entire financial system collapsed. 2024 and 2025 are following the exact same pattern. The difference is the bubble isn't just housing this time. It's everything. Stocks, real estate, commercial property, corporate debt. The entire financial system is overvalued and overleveraged. And the insiders see it, so they're selling. Bezos, Zuckerberg, Dimon, Ellison, the Waltons, NVIDIA insiders, they're executing the 2007 playbook. Sell at all-time highs. Get to cash. Wait for the crash. Buy everything back at 50% off. Let me show you what they're seeing that's driving these sales, because they have access to data and analysis that retail investors don't. First, they see the Buffett indicator. This is the ratio of total stock market capitalization to GDP. Warren Buffett has called it the single best measure of market valuation. When the ratio is below 80%, stocks are cheap. Between 80 and 120% is fair value. Above 120% is overvalued. Above 150% is bubble territory. The Buffett indicator right now sits at 185%. The highest in history except for the brief spike during COVID. This means the total value of all stocks is 185% of the entire economy is output. Stocks are valued at almost twice what the economy produces. That's mathematically unsustainable. It can only persist if you believe the economy will grow 50% while stocks stay flat, or that profit margins will double. Neither is realistic, so the indicator is screaming overvaluation. The insiders see this. They know it has to revert to the mean. And mean reversion from 185% to 100% means stocks fall 45%. Second, they see the Shiller PE ratio. This measures stock prices relative to 10 years of average earnings adjusted for inflation. It smooths out short-term fluctuations and gives a long-term valuation picture. The historical average, Shiller PE, is 16. Below 10 is cheap. Above 25 is expensive. The Shiller PE right now is 34. That's the third highest in history. Only the dot-com bubble in 2000 and the COVID spike were higher. Both were followed by crashes. 34 means investors are paying $34 for every dollar of average inflation-adjusted earnings. That's double the historical norm. For this to be justified, you'd need to believe earnings will double from here while stock prices stay flat. Or that interest rates will go to zero and stay there forever. Neither is happening. Insiders know this, so they're selling. Third, they see margin debt. This is money borrowed to buy stocks. When investors are optimistic, they borrow to amplify returns. When they're scared, they pay down debt. Margin debt reached $950 billion in late 2024, near all-time records. This is dangerous because leverage works both ways. If stocks rise 10% and you're leveraged 2 to 1, you make 20%. But if stocks fall 10%, you lose 20%. And if stocks fall enough, you get margin calls. You're forced to sell to pay back the loan. This creates cascading forced selling that accelerates crashes. In 2007, margin debt was at record highs right before the crash. In 2008, as stocks fell, margin calls forced massive selling that accelerated the decline. Margin debt went from $800 billion in 2007 to $400 billion in 2009. That $500 billion in forced selling helped crash the market. Right now, we're at similar levels, $950 billion. The insiders know that when the market turns, this leverage will amplify the decline, so they're getting out before the cascade starts. Fourth, they see corporate debt. U.S. companies owe over $12 trillion. Much of this was borrowed at low interest rates between 2009 and 2021 when money was cheap. But those bonds are maturing. They need to be refinanced. And current interest rates are 5 to 7% instead of 2 to 3%. This means companies that could afford debt service at 3% interest can't afford it at 7%. They'll default. We're already seeing this in commercial real estate. Office buildings that borrowed at 3% can't refinance at 8%. They're defaulting. Handing keys back to lenders. The same dynamic is coming for corporate debt. Trillions in bonds mature through 2025 and 2026. Much of it can't be refinanced at current rates. Defaults will spike, bond prices will crash, credit spreads will blow out. This will cascade into stocks. The insiders running these companies see their own balance sheets. They know which companies can't refinance debt. They know the defaults are coming, so they're selling before the credit crisis hits. Fifth, they see commercial real estate. Office buildings across America sit 40 to 50% vacant. Remote work is permanent. Companies that leased 5 floors now lease 2. Buildings bought at peak prices with 3% mortgages are now worth 40% less, and those mortgages are maturing. When owners try to refinance at 8% interest, the numbers don't work. They default. Over $2 trillion in commercial mortgages mature through 2025 and 2026. A significant portion won't be refinanced. The defaults will hit regional banks first, banks that have 20 to 30% of their loan books in commercial real estate. When those loans default, the banks take losses. Those losses eat through capital. When capital falls below regulatory minimums, regulators close the bank. We saw previews of this with Silicon Valley Bank, First Republic, and Signature Bank in 2023. All failed even though we weren't in recession yet. Now, the commercial real estate wave is coming. More banks will fail. The insiders, especially Jamie Dimon, who runs the largest bank and has perfect visibility into this, see the coming banking crisis. So they're selling. Sixth, they see the federal deficit and debt. The U.S. government is spending $2.4 trillion more than it collects in taxes every year. The debt is $38 trillion and growing. Interest payments alone are $1.2 trillion per year, the second largest line item in the budget after Social Security. By 2027, interest will be $1.8 trillion if rates stay at 5%. This is unsustainable. The government will either have to cut spending dramatically, raise taxes massively, or print money and accept high inflation. All three options are economically destructive and politically difficult. The insiders know there's no good outcome here. The debt spiral ends in crisis. Currency devaluation, possible default, or austerity that crashes the economy. So they're converting assets to cash while they can. Seventh, they see the yield curve. The yield curve inverted in 2022 and stayed inverted through most of 2023. This means short-term treasury bonds paid higher interest than long-term bonds. An inverted yield curve has predicted every recession since 1950. No false signals. When it inverts, recession follows within 12 to 24 months. The curve inverted in mid-2022. We're now in month 36. The recession hasn't started yet officially, but unemployment is ticking up. Layoffs are increasing. GDP growth is slowing. The insiders see the leading indicators. They know the recession is coming. And when recession hits, corporate earnings fall. Stock prices fall. They're selling before that happens. Eighth, they see insider data that you don't. Jeff Bezos knows Amazon's real sales trends, not the reported numbers, the real internal data. He sees if growth is slowing, if margins are compressing, if competition is intensifying. Mark Zuckerberg sees Meta's real user engagement, real ad pricing trends, real cost of AI development. Jamie Dimon sees JP Morgan's real loan default rates, real credit quality deterioration, real problems in commercial real estate and consumer lending. These men have information you won't see until quarterly earnings reports 3 months later. And by then, it's too late. They're selling now because the internal data is worse than the public narrative. The growth is slowing. The problems are mounting. The stocks are overvalued. And they're getting out while they can. This is why they're all selling at the same time. They see the same data. They reach the same conclusion. Stocks are overvalued by 40 to 50% based on every metric. The economy is slowing into recession. Corporate debt defaults are coming. Commercial real estate is collapsing. Regional banks will fail. The federal debt is unsustainable. And their own company's internal data is deteriorating. The risk reward is terrible. Holding stocks at these levels risks losing 40 to 50%. Selling might mean missing another 10 to 20% upside if markets continue rising irrationally. But if you're already worth 100 billion, missing 20% gains on 1 billion is only 200 million. Losing 50% is 500 million. The risk outweighs the reward, so they're selling. Now let me show you what happens next, because we have historical precedent. In 2007, insiders sold at record levels from January through September. The market peaked in October 2007, then it crashed. The S&P fell 57% from October 2007 to March 2009. The insiders who sold in early 2007 at market highs watched the crash from the safety of cash. Then, in March 2009, when the S&P hit 666 and everyone was predicting the end of capitalism, those same insiders bought back in. Warren Buffett invested $5 billion in Goldman Sachs in September 2008 at the peak of panic. He made billions. John Paulson, after making $15 billion shorting subprime mortgages, bought stocks at the bottom in 2009. He made billions more on the rebound. The pattern is always the same. Sell at the top when everyone is euphoric. Wait through the crash. Buy at the bottom when everyone is terrified. The 2024 and 2025 insider selling is stage 1, selling at the top. We're watching it in real time. Stage 2 will be the crash. Based on historical patterns, the crash typically follows insider selling by 12 to 18 months. Insiders sold heavily in early 2007. The crash began October 2007, 12 months later. If 2024 was the heavy selling year, the crash likely begins late 2025 or early 2026. The trigger could be anything. Commercial real estate defaults cascading. A major bank failure, a tech stock collapse, a geopolitical crisis. The trigger doesn't matter. The system is fragile, overvalued, overleveraged. Any shock will start the cascade, and once it starts, forced liquidation amplifies it. Margin calls, algorithm selling, panic. The market could fall 30 to 50% in months. Maybe more if it's worse than 2008, which many indicators suggest it could be. Stage 3 will be maximum fear. This is when unemployment spikes, when banks fail, when corporate defaults surge, when the media runs 24-hour economic collapse coverage, when regular people are terrified and selling everything. This is the bottom. And this is when the insiders who sold at the top in 2024 will deploy their cash. They'll buy stocks at 50% discounts. They'll buy real estate being foreclosed. They'll buy businesses being liquidated. And they'll make fortunes on the recovery over the next decade. This is the pattern, and it's playing out right now. So what should you do? You're not a billionaire insider with perfect information, but you can recognize the pattern and position accordingly. First, understand that you cannot time the exact top or bottom. Bezos might be selling too early. Stocks could rise another 20% before crashing, or the crash could start tomorrow. You don't know, but you can see the direction. Valuations are extreme. Insiders are selling at record levels. The macro setup is terrible. The crash is coming. Maybe 6 months, maybe 18 months, but it's coming. Second, reduce your equity exposure if you're heavily invested. If you're 70% stocks right now, consider reducing to 40 or 50%. Raise cash. Yes, you might miss some gains if markets continue higher, but you'll preserve capital when the crash comes. And that capital becomes buying power at the bottom. This is what the billionaires are doing. They're reducing risk. You should too. Third, hold gold as wealth preservation. When the crash comes, the Federal Reserve will print unlimited money to bail out the system. Just like 2008. Just like 2020, that money printing devalues the dollar. Gold preserves purchasing power. 5 to 10% of your portfolio in physical gold or gold ETFs protects against currency debasement. Fourth, consider buying protective puts. Put options on SPY or QQQ give you the right to sell at predetermined prices. If you buy puts with a strike price 10 to 20% below current levels expiring in 6 to 12 months, you pay a small premium. If the market crashes, those puts explode in value and offset your stock losses. If the market doesn't crash, you lose the premium, but it's insurance. You pay for protection. Fifth, have a buy list ready. When the crash comes, when the S&P is down 40 to 50%, when everyone is terrified, you need to know what you're buying. Make a list now of quality companies you want to own. Companies with strong balance sheets, low debt, recession-proof products. Apple, Microsoft, Visa, Johnson & Johnson, Costco. When these companies are on sale at half price, you buy aggressively with the cash you preserved. This is how wealth is created during crashes, not by panic selling at the bottom, but by buying quality at discounted prices. Sixth, don't try to be a hero. Don't short the market unless you're extremely sophisticated. Timing shorts is incredibly difficult. The market can stay irrational longer than you can stay solvent. The billionaires aren't shorting. They're just selling and raising cash. You should do the same. Sell, raise cash, preserve capital, wait for the bottom, then buy. Simple, effective, proven. Here's the bottom line. The billionaire exodus is real. 13 billion from Bezos, billions from Zuckerberg, first ever sale from Diamond, 3 billion from Ellison, billions from the Waltons, 700 million from Nvidia insiders, 464 billion in total insider selling in 2024, the second highest year on record, the sell to buy ratio at 9-1, the most extreme in history. This isn't diversification. This isn't tax planning. This is the smart money getting out before the crash. They see the Buffett indicator at 185%. They see the Shiller PE at 34. They see margin debt at record levels. They see corporate debt that can't be refinanced. They see commercial real estate collapsing. They see regional banks failing. They see federal debt spiraling. They see recession coming. And they're selling. The pattern from 2007 is repeating exactly. Heavy insiders selling 12 to 18 months before the crash. We're in that window right now. The crash is coming. Late 2025 or 2026. Maybe sooner. Maybe later. But it's coming. The billionaires are telling you this with their actions. They're screaming it with their sales. The only question is whether you're listening. If this video showed you a pattern you hadn't seen, if you understand now that the largest insider selling event since 2007 is happening right now, subscribe to this channel. Because over the next 12 to 18 months, I'll track every major insider sale. Every signal that the crash is approaching. Every warning sign. You'll see the billionaire exodus continue. And you'll know when the crash is imminent. This is not financial advice. This is pattern recognition. The pattern from 2007 is repeating. Insiders sell at the top. The market crashes 12 to 18 months later. The insiders buy at the bottom and get richer. The pattern is clear. The billionaire exodus has begun. The crash is coming. Position yourself accordingly.